Hello, ladies and gentlemen. Well, we've had quite an improvement in the risk dial this week. It closed the week at 54, where it was actually on Thursday. But as you can see, we are improving the moving averages by about 2 points per day, which basically means that on Thursday we should have a cross, and that will mean that we will be in a risk-on period. A risk-on period can mean two things. It could mean sideways action for a while and then a thrust higher, but it also can mean a melt up. So for the time being, the base case scenario, for a variety of reasons, has to be a sideways move in the SPY, and then only in a month or so, once the weekly model has also given a buy signal, and that is probably another 3 weeks away from doing so, then we should start seeing a decent move higher. But certainly the risk spreads, and don't forget that this model is based on spreads, not on the price of SPY or TLT, is saying that we are going into a risk-on phase coming very, very soon. If we look at the deviations page, we will see that SPY has actually touched the red zone. You will see how here, here, and here, all of last year, we always respected the red zone. That is why I think that we are more likely to just go sideways, to maybe have a couple of bad days where we lose 1%, where people come back in and buy it higher. But certainly this market needs time. If you look at all the various sectors, they are all very, very close to the red zone. It is, to me, inconceivable. The only one that can, do a little better is utilities, but I just don't see that. I see the utilities coming off, if anything. XLB materials, it's all very, very close to the red zone. This is XLK. I'll maximize this for you. You'll see how XLK probably can continue to do a little bit better, but not much. XLV is now actually a buy, very, very close to the green zone. So I would encourage you to have a look at all of these. XLF, you can see how it's got into the red zone. So it's unlikely to do better without a bit of sideways action. And that's why a melt up just cannot be my base case. My base case has to be a very small improvement in SPY over the course of the next week, with the top around somewhere around equivalent of SPX around the 25 to 30 area. So we're only talking about less than 1% away from something which should produce a meaningful correction. As far as the fundamentals are concerned, it's very rare that we have managed to stay at or above the time 17 Blue Angel. You can have a look at the past history, and you can see how very unlikely this has been throughout the observable period. A small period here in, it just very unlikely that we stay above it for any length of time unless we are going to go into a complete melt up. You can't legislate for melt ups, but what we can do is play the odds, and the odds say that really 29.25, 29.35, which is these highs here, is unlikely to be broken unless we get the melt up, but we can't legislate for that. All we can do is have some options as protection, but basically that is all we can do at this stage. Our old friend, the differential between bunds and 10-year notes, is still firmly stuck in the middle of the trading range. This, well, I don't know, some call it potentially an inverse head and shoulders. I have no idea. I will play the break. I will not play in this range, this very tight range. I am still convinced that the central banks are managing this, and I just, will not play. We can have a look at the bunds next, and that is interesting because the bunds closed at 6 basis points. You remember our line in the sand for the swing is basically 7.8, 7.9 basis points, call it 8 basis points. If it closes above 8 basis points, it always goes at least 3 basis points, but if not a lot higher. You can see what happened when we had the impulsion higher here back in whatever that was, 2013, 2014. I still think that trading against '08 is good risk reward, i.e. getting long of futures for a move back down towards zero, because the stop can be so tight. The stop can be 1-2 basis points, which is basically 15 ticks in the bund, almost nothing. And therefore that is what I plan on doing. If we look at the 5-year note, it has exceeded the 235 level that was so important, closed awfully, almost certain to go to 243 next week. This is a good level, 243, but actually quite likely at some stage to see this 252 level. So we are definitely in a period, because if you just go A, B, C, that actually targets around the 250, 252 area. I don't see it any higher than that, but that will actually imply that we break the 8 basis points level in the bund. And if you look at the 10-year, what does that give us? The 10-year gives us certainly 262 next week, certainly 262, but then it could actually give us even 273, 274 at some stage, which is going to be a much higher level of bund, and that is what I actually expect to happen, because when we get a sizable move out of fixed income and into equities over the course of the next several months, that to me tells me that fixed income is likely to be on the weak side, and therefore my longer term perspective for the 10-year note is at least 274. So I really think that the 10-year can get to 274 over the course of the next month or so, and I'm just not long of bonds unless I'm trading tactically from the 8 basis points in the bund. It just tells me actually that the break in the differential between, and this is exactly what I showed you, the differential between the bund and the 10-year note is actually likely to be on the downside, and that would give us the stronger dollar and the breaks above 97.50, whatever that level is that we'll look at later in the DXY. That is where the odds are leading us at the moment. It is not often that I show you a chart of gold, but we're trying to piece together all these various pieces of the puzzle. So if the 10-year goes up in yield more than the bund, and the bund stops at 8 basis points, what does that mean? That means that the dollar should start trending higher, and if the dollar should start trending higher and yields are going up, then gold gets hit. Is that what this chart is showing? Is the gold chart showing that it's going to get hit? Well, it certainly has room to come to this level, which is the 1266, 1267 level. We'll put it in there. I am quite happy to be short of gold at the moment for this move down to the 200-day moving average down to 1267. That is what is making the most sense at the moment, being short of the 10-year, being long of bonds when they get to 8 basis points against it, looking to be long of the dollar, and looking to be short of gold. For a move down to this level, 1265 to 1270, where I definitely would cover. Moving on to equities, well, ES is doing absolutely nothing wrong, is it? It is being maintained by all the moving averages. We have room over the course of the next week to basically go up towards these highs. We have a couple of gaps there. Certainly, you know, it's holding these moving averages so well. I still think that at some stage people are going to get just too long in here, and there's going to be a lovely opportunity to buy the dip down to 28.64. But you can't legislate for it. All I know is there is absolutely no reason to short this market. Yes, I showed you in the deviations that we are entering the ×2 standard deviation red zone, and that says caution. All that to me says is that if you want to be long, you transfer your positions from long outrights to long calls. Volatility is very, very cheap. I will show you in a moment how cheap. That to me says there is absolutely no reason not to pay up for calls and get out of the outrights. This is an hourly chart of the ES, and basically this is the trend line that it's holding from way back. To me, it will keep on going higher, but at some stage all these little gaps that it's left behind will get filled. It's just a question of when and why. We have certain divergences. If you have a look at the RSI, it's diverging against price. It just, with the level of volatility that we are encountering, which is as low as you're likely to have for the foreseeable future, it just seems completely silly not to transfer your position into options as opposed to outrights. It is so cheap, it is just a no-brainer. For several weeks in volatility I've been saying, look for this gap fill, 1150, 1160. Look how close we are now, 12. To me, when that gap fill occurs, it is just so unlikely that at some stage we don't have at least a pullback to the red moving average, which is at the moment around 13.25. That to me says it's a no-brainer to transfer any long positions in equities from outrights into options, into call options, and it's also no-brainer to speculate against ES via volatility, via being long of volatility, rather than by going outright short of ES. The reason why I am afraid of a melt-up type scenario is because the weakest, or what should be the weakest of all the indices, which is DAX, is just not giving us any satisfaction on the downside. This gap should have got filled. It didn't. It stopped short of the gap and straight up. You will remember what I said last week. Quite possible that we go to 12,086, 12,100 and then come down. Well, that is still on the cards. I still think we definitely trade 12,086, 12,100. But if it doesn't stop there, it is going to go to at least 12,359 and more than not likely is 12,600. So 12,500, 12,600 will then become the objective for the DAX. Well, if the weakest sector, if the weakest market, which is Europe, is going to still give us that much, you could easily see this melt up in the States, and that, it's of course is going to be a wonderful opportunity to sell it at some stage, but for several days you are going to be, having your hair in your hands in your hair, and you'll be tearing it out, and you will saying, why did I sell, why did I sell? Well, that is why I keep on saying, transfer your what you would like to be short of into volatility as opposed to outrights, and don't be long of outrights in the red zone, because it never pays. Eventually it becomes a silly thing to have done, and transfer it into calls. That way you get the best of all worlds. Volatility can go up even if the market is going up. Never forget that. Volatility doesn't just go down when the market is going up. Volatility can go up when the market is going up and accelerating higher. Therefore, the best hedge you can have at this point in the cycle is probably longer volatility when it fills the gap I showed you in the previous clip. Emerging markets on a weekly basis is a weekly chart. You will remember the 4504 level that I put in. It's still there. My offer is still there. They've done really nothing this week, and it's just showing that certain markets just cannot follow the strength of the states, and it makes sense. That 4504 level should prove very, very difficult to break, and I'm certainly a buyer of puts at that level. When will the market potentially accelerate? Well, potentially it will accelerate when the Russell breaks the previous high, which is just over 1600 at 1602. I have calls, call spreads. I think there's quite a good chance that Russell does break it, because it has been so much weaker than all the other markets, and therefore it is the one which has the most room to catch up. This could happen because oil goes up. It could happen because of the rotation in financials. If we get higher rates, we definitely will get a rotation into financials, and therefore Russell will benefit the most. To me, Russell is probably the best risk reward in being long of call spreads. Well, can XLF rally? Yes, it can, because if we are right and we see the pullback in the bonds and the steeper yield curve, this spread will move very quickly back up to 3 basis points, 4 basis points, even higher, maybe even 5. And then we get XLF targeting probably this kind of area, 23 and a half. So what we can do is actually put in a trend line and see. We certainly can get to that trend line very quickly, and if we break it, then we're probably looking to trade certainly around these previous highs, around the 23 and a half area. I will keep a very sharp eye out for this kind of behavior, but all the pieces are coming together, aren't they? Slightly higher dollar, higher yields in the States, not such high yields in bunds, down in gold, up in XLF, up in the Dow, and the Russell outperforming. Let's have a look at the dollar. Well, 96.50, back down, and then back up and closes through the 97.50 to 97.90 area. That seems to be the likeliest path. If we are wrong, actually, and I'll enlarge this for you, you can see it, If we are wrong and it comes through 97.50, well, the 200-day moving average and the bottom of the Bollinger Bands are so close that, where are they? They're 96.10. So you're talking about 40 pips. That's nothing. We break that 200-day moving average, we are out. This is being long of the dollar on little dips over the course of the next 3 or 4 days, or being long of calls, is going to be, because volatility is just so low, is going to be a wonderful risk-reward trade, isn't it? It just makes so much sense. Buy calls so closest to 96.50 as possible, and basically if it breaks the 200-day moving average, you are out and no harm really done. It's certainly going to be a 3 to 4 times risk-reward play. Well, here are our biases for next week. As I said, in the 5s and 10s, our new levels are 250 to 252 percent, and in the 10s 261. Those will be the levels that we'll be looking for over the course of the next couple of weeks. And in the bunds, I'm still bullish unless it takes out 8 basis points. I'm still very tempted to buy futures when it gets to 8 basis points, and then certainly against the position in the 10s, and then we see if it breaks above 8 basis points, I can get out very cheaply. I'll only give it like 2 basis points room. Close above 8, I'm out. Now, we keep on saying 28.64 is going to be a very important level, and I still think that we see 28.64 at some stage. Now, what is the top going to be next week? 29.25, 29.35 would make sense as a top. And then when you get a market which is very overbought, like the S&P will be by that stage, you are really looking to be long of volatility, as I said earlier, or put spreads, because very little, it's going to take very little for the market to break and go all the way down and fill all the gaps down towards 28.64. That to me still is the base case scenario. I'm not ignoring the possibility of a melt up, but there you have it. NQ is the reason why I don't think we're going to get a melt up, because NQ really has to participate for us to get a melt up. I will only change my mind and make the melt up my base case scenario if NQ starts leading, and at the moment it just isn't. To me, NQ is exhausted and it can't do very much. But this is the important one to me. VX at that 1150 level, to me that is going to be so important. It's going to be the opportunity, because it tells you that if volatility is bottoming, you really need to either to really play heavy in options, because they are probably as cheap as they're going to get. I am still very weary of this. This is a very good possibility, 12,060, 12,100, but still this is very much the truth. If we go through there on a couple of closing levels, then a melt up is quite possible, and I showed you in the DAX clip how far that can go. In the dollar, I have changed this slightly because now it makes sense. 96.50 is, or very close to, is where you should buy calls, because the risk reward is there. And I showed you also how that fits in with gold, and gold could easily break into 1,260 to 70 area, where certainly it's worthwhile covering the position. Volatility in gold is very cheap. 1,300 puts are very cheap, and out at 12,000 at 1,260. Thank you very much indeed, and tweet you on Monday.